PayPal, like a lot of other hype stocks, is down a ton. This is a great way to start looking for value. Remember, we don't want to be affected by recency bias. Seeing a stock going down and thinking it's bad is just as bad as seeing a stock going up and thinking it's great. My personal opinion on PayPal, I love the service. I think they have some sort of a moat, not a huge moat, but I think people use PayPal and they trust PayPal. They also own Venmo, which is a very popular, it's even used as a verb now. Hey, Venmo me. I personally love PayPal because of the security and the safety I know I'm going to have when I buy something with PayPal. So the question now becomes, there's a difference between the stock and the company. I love the company. Do I love the stock? We're here to analyze the stock and see what it looks like. So let's go to our 8-pillar software and pull up just a little PayPal action over here. So guys, like I was saying, look at the stock chart. Since August, it had a high of $310 or so, and now it's currently sitting at 78 bucks. That's a drop of 75%. That's a big drop. So a lot of people would sit there and say, oh, the stock is garbage. Well, wait a second. That makes no sense to me. Remember, we want to pay less for the things we love. Is PayPal growing? Yes, it is. So why is it down so much? The biggest negative I see with PayPal is their guidance for the future was worse than it was before. And if you bought the company here expecting major guidance and major growth, of course you're going to be disappointed. That's why, from a value investing standpoint, our goal is to make conservative assumptions. That way, when they do guide lower, that guidance is still better than our conservative assumptions. Is it rare to find those? Maybe, but your goal is to look at 10,000 stocks out there and find the 20 or 40 that make sense. So let's look at PayPal and see if it makes sense. Here's our 8-pillar process. Here are the 8 pillars. Guys, we have check marks everywhere but one. The PE over the last 5 years is 30 versus 22.5. Now, something interesting here. Earnings and cash flow should be very similar over long periods of time, but our ratios are different on the price of free cash flow versus the PE. That could be for many reasons, one of which might be they might have a write-off somewhere along the lines that really dropped their earnings but didn't hurt their cash flow. So this is something I want to look at. But buying back shares, low debt, great increase in free cash flow, great increase in net income, great increase in revenue, and a high return on invested capital. These are the things we like to see. When a company has these attributes, you want to kind of stick to them. It's just a matter of picking what price is still the right price. Because even if everything is stellar here, if you overpay, you've made a great company into a bad investment. And that's what we want to avoid. All right? So let's look at what the analysts are saying. Now, guys, for those of you out there who know and watch this video, this channel, I'm not a huge fan of analysts over the long run, but it's a nice way to get a guidance for where people are going because they are very active. So for this year, they are actually estimating a drop in earnings, okay? But from here on out, look at these increases in earnings per year, percentage-wise. These are analyst estimates. So right now, as of December 2027, they're expecting triple the earnings per share as they have today. That's pretty stellar. So if they're able to keep everything the same and they triple their profit from here, if you pay a reasonable price for the company, you should be able to triple your stock value. Remember, it doesn't mean just because it's going to triple, it's going to be great. Remember Intel, Cisco, these two companies back from 2000. Since 2000 and now, their revenue and profit have tripled since then, and their stock is still below their 2000 peak. So if you overpay, even for a good thing, you will still get a bad return. So that's one great company you can find with 52-week lows. Another one, Home Depot. So let's do the exact same thing. Let's go to our 8 pillars, pull up the Home Depot. Look at this chart, guys. A high of 420, and the company is currently at 290. Not as bad as PayPal, but this is Home Depot. This is a very established business. They have thousands and thousands of locations around the world, and this drop was even faster. At the beginning of the year, this company was at 420. One thing also, that dividend yield, 2.3%, $7 billion of their $12.5 billion in the last 5 years and $14 billion last year. So they can easily afford this dividend from what I see. Okay? High return on invested capital, 28% return on invested capital. Guys, Home Depot. If you were to ask me, what's the number one store for home repairs, things like that? Home Depot. Yeah, Lowe's is there too, but Home Depot it's awesome, right? And they make buying online very easy. And you want to go there to get advice from people, right? You want to go there and say, hey, how do I do this? And they'll help you along the way. So let's look at their 8 pillars. All right. What we love to see, guys, in the sense of every metric that we love here is a check mark. We're just waiting for valuation. And look at their PE and their price to free cash flow. Very, very similar, right? 24.21 and 25, very close to each other. All right. So these are good things to say, okay, there's nothing, no big write-off. They're very consistent. This is if these were very, very different and there was no explanation, that's a red flag for fraud. So I'm looking at this saying, I like this so far. Now let's look at what analysts are saying. Here's the analyst estimates for earnings per share for the next 10 years. This year, they're expected to make $16, then $17, then $18. So the growth is pretty decent, but not huge, but pretty decent. I would expect Home Depot to grow somewhere around where inflation is going to be in terms of their EPS, maybe a little bit better. It's so big, guys. You can't get a huge growth number from Home Depot. And that is why I don't like high PEs. On larger companies that have less growth potential, you cannot give them a high PE. You give high PEs for more growth potential. But that is not possible with Home Depot because they're freaking huge. In any city in the US, I don't care how small it is, if you just go to your phone and say, Siri, where's the closest Home Depot? You're probably pretty freaking close. So with Home Depot, I'm looking at this saying, okay, I just need to wait for a calmer time, right? I need to wait for the stock to fall just a little bit more to get in my sweet spot. The great news is as the stock falls, your dividend yield is going to go up. So this 2.3% dividend yield, which is already double the market, could get even better as the stock continues to fall. So my opinion is I'm going to put it on my watch list and pay attention and apply my process to Home Depot as the stock continues to fall, if it continues to fall. Final stock, Nike. Guys, I kept this one for last because I am a Nike fanboy. I love Nike. Don't even talk to me about Adidas. But again, we got to separate the company from the stock price. Love Nike, the company. The question is, do I love the stock price? So let's go pull up Nike in our software. So here's the stock, a high of 180 and a low of 108. It's pretty much sitting at that 108 price right now. Guys, that's a drop of over 35%. Now remember that, 35%. At these peaks, it's hard to imagine a stock falling 35%, especially 7 months later. But that's what happened. Why? Because even great companies will see stocks fall if there's overvaluation. And I'm not saying Nike was overvalued, but I think we did some videos in the past. We thought it was overvalued, but it's all based on your assumptions about the future. So what we're going to do here is we're not only going to look at the 8 pillars, but then we're going to do the stock analyzer tool, use this amazing tool we have in our software to figure out the exact price that I would want to pay for Nike if my assumptions are correct. So first, let's pull up the 8 pillars. Guess what we got here, guys? My favorite. Check mark, check mark, check mark. All these check marks. They're buying back shares. They have low debt, increasing cash flow, increasing net income, increasing revenue, and a high return on invested capital. Guys, Nike has an amazing moat. They have look at Under Armour. Under Armour a few years ago went out there and tried to get a ton of people to sign up with them. They even have Steph Curry, but they can't even hang with Nike. Their stock is through the pooper now because of earnings having a problem, revenue growth being a problem. So I look at Nike and go, this is really expensive. 43 and 42 price to PE and price to free cash flow. So again, unless they're going to have some major growth, which might be hard, that's something you have to consider. So let's pull up the analyst estimates for Nike's earnings per share growth over the next 5 to 10 years. 5%, 24, 19, 11, 9, 5, 10, 11. So guys, it's there. And these are analyst expectations. And the further away you get, the less reliable they're going to be. But I look at this saying, this is be a good place to start on making your assumptions for the future. Same with the revenue growth. The revenue growth numbers. They're expected to do $47 billion this year, and they hope to get to 91 by 2031. Guys, that's not major growth. That's not even double in 8, 9, 10 years. That's a very low growth rate. So with a low growth rate, what does that mean? We have to pay a lower PE. So let's go to our stock analyzer tool right now and use a 10-year analysis. You can do 1 to 20. Let's do a 10-year analysis to determine what we want to pay for Nike. Now remember, I'm going to repeat, the numbers I'm going to put in here are completely based on me, and you have to do your own analysis with the software yourself. I'm also going to be very conservative because my personal goal is to buy great companies at good prices. I don't need to get, and I want to be conservative, so it's like a no-brainer to me. So, revenue growth numbers. They did 7% in the last 10 years. I'm going to go 2, 4, and 6. Profit margin. I'm going to ignore last year because the other ones look more consistent. I'm going to do 9.5, 10, and 10.5. Free cash flow, 9.5, 10, and 10.5. Same thing. Now, PE, guys, I'm going to do 14, 16, 18 because I'm okay paying a little bit above the 15-year historical average because of Nike being a moat. Some would argue a higher PE. I don't know if I disagree with them on that one. This one's kind of where you go, hey, what PE should I pay for this company? I don't know. This is subjective. But let's start here. And I always put in 12.5% return in because that factors in my margin of safety, as well as I can get 9 or 10% in an ETF over long periods of time. This gives me a little bit extra. I hit the analyze button. All right, guys, we got a long way to go. We have a low of $31, a high of $53, and somewhere in the middle in the 40s. So what I'm going to do here is I'm going to add Nike to my watch list when it hits this high number to notify me when it goes below then, because I want to be notified as it's going down because I want to sell puts to buy Nike at future prices and be paid for that right. The other thing is the numbers, by the time it falls to 52 or 55, if that happens, the fundamentals might get better. So in fact, I might want to change this to actually I'm going to do that right now. I'm going to change this to 65. When it hits 65, notify me. Why? Because I want to make sure that if by the time we get to 65, maybe the fundamentals have gotten better and can justify a higher price. So at 65, I can either reevaluate, and if I still say, hey, it's worth somewhere in the 50s, I can write the appropriate puts. This is how you evaluate a company and determine the prices you're going to pay for them.